silver just kissed $70 and stepped back. On Friday the 28th of August, 2026, spot silver is trading near $69.68, down about 0.5%. That follows Thursday's push above $70, with an intraday high around $70.54. OCBC sees this as consolidation right at a major resistance barrier, not a confirmed breakout. The $70 zone is exactly where their technical map expects sellers. Meanwhile, $67.40 is the pivotal support underneath. The market is now pinned between a key ceiling and a critical floor, and the next move depends on positioning, not just price. The recent push higher was not driven by silver itself. A key trigger was the US Treasury's decision to increase buybacks of older, long-dated bonds. That reignited fears of dollar debasement, pushing traders into gold and silver as a hedge. But back on the 30th of June, OCBC slashed its end of 2026 silver forecast to $67 an ounce, down from $89.50. The reasons were a sharp repricing in real interest rates, renewed dollar strength, and a more hawkish Federal Reserve. On the 13th of August, JP Morgan said silver should average $70 this year but drop to $63 in the fourth quarter. So this rally is a macro trade, not a fundamental shortage story. Now the deeper problem. The latest managed money data for the week ended the 21st of July shows long positions increased only modestly, while short positions rose more. That means net long exposure actually declined. Investors have not rebuilt meaningful upside conviction. At the same time, ETF holdings were down 9.2% year-to-date as of late June, with roughly 79.1 million ounces of net sales. OCBC expects a global structural deficit of 46.3 million ounces this year, but that shortage cannot protect prices when the macro backdrop turns. Silver also trades as a high beta version of gold, meaning it moves more violently in both directions. That is why $70 feels more like a trap than a launchpad right now. OCBC says silver's near-term direction will remain volatile as investors assess U.S. monetary policy and global growth. A sustained recovery probably needs softer U.S. real yields, a weaker dollar, or stronger gold. With Jackson Hole keeping consolidation risk elevated, the immediate test is whether silver holds $67.40. If it does, $70 remains the level to beat. A daily close below $67.40 would expose the next support zone. The $63 to $64 area is the first downside magnet, which also lines up with JP Morgan's fourth quarter target. So do not focus on headline price alone. Watch volume, ETF flows, and whether money managers finally start cutting shorts. The takeaway today is clear. Silver has reached a major resistance zone, not confirmed a new bull market. The structural deficit is real, but it is a slow-burning support, not a daily price driver. Right now positioning is fragile, ETF flows are negative, and the rally leans heavily on the weaker dollar theme. If you are trading this, wait for a decisive break above $70 with renewed ETF demand and rising net longs, or prepare for another retreat toward support. Until then, patience inside the range is the smarter trade.